So I own and operate a large seniors housing campus in a primary market. And because my occupancy is in the 90s, of course, I now want to do a significant aisle expansion, plus some renovations of my existing buildings. So what are my financing options for this? And I've heard about CPACE, so can I get in on the game there? But also, is expanding my IL portion the best option? Could I get more bids from lenders if I wanted to expand my ALMC portion, or maybe do an active adult expansion?
I can take a first run at it. I think I'll let the lenders in the room talk about CPACE. Your market study overall should dictate what you put in there, and you should know it. What a lender wants to see should be very easily supported by a market study and demographic backup. So whether or not it's an IL expansion, active adult, or AL memory care, you should know that answer. And that answer should be well supported by a demographic study and a market study. You should be fluent with what the competitive market looks like, and you should be able to determine what the best return on investment is for the acuity type that you plan to expand into. So I would just say you would know that going in. I think if you come with a well-founded demographic and market study, the lenders are going to have to agree with you. Opinion doesn't factor in. As it relates to financing, there's a couple of things that I would consider looking at this thing. Number one is this thing zoned and approved? Do you have the ability to alter collateral given your existing mortgage scenario? If not, can you amend the mortgage documents that allow you to change the collateral, even if you're improving the collateral? So many agency loan documents do not allow you to change the collateral. And in some situations, depending on who owns the mortgage-backed security, that answer is always going to come back as no if there's any financing or the potential for any lien to be put on the campus. So being well-versed in what your documents allow you to do, and as important, whether or not the documents can be amended to allow you to do what you do, are paramount in considering this thing. So I would tell you, you should build what you know will work there and what will be the best return on your investment. And then as important, do you have the documentation to allow you to do this? Or do you have to look at a financing situation where you're going to refinance the existing campus and either have enough funds for the development or certainly allow you to develop on an all cash basis? It's a pretty significant diligence process. But I would put those two things as paramount to the process. And I'll defer CPACE and financing options to my colleagues here.
Yeah, I think that's right on. The existing debt is kind of my first question as well. I guess one of the nice things is if you have imputed equity in the existing building, given the operations, you may be able to leverage, the current business in order to defray, probably not eliminate, but to defray equity requirements on an expansion. So I think that could be used to your benefit in capitalizing the whole building. A supplemental finance or in some cases like a subdivision, right, or parceling of the property would, having this as siloed financing, existing building, new building, probably would create a higher equity requirement. So I think thinking through some of those options that the debt either allows or does not allow is worth considering. On the pace side, I'm not going
And
to.
Nick, sorry, just to
Yeah,
quickly interject, we had an audience question directed to you to explain how agency lenders look at CPACE as well.
got it. Yeah, so I'm going to sort of acknowledge that I'm not a CPACE expert, but we have done some transactions where we've put bank and CPACE together. The idea is that those become agency or HUD eligible in the future. These CPACE is a construction specific or recent construction specific program. So, typically these are going to be put in place with a conventional lender. Um, and that's just because like Fannie and Freddie, for example, will only finance stabilized assets. One of the nuances that we've seen a little bit is that CPACE is a subordinate mortgage, but it does have some rights in the event of a default or an acceleration. And so a lot of times I think we look to what the construction lender's appetite is on CPACE. Some construction lenders, if they say, hey, we'll give you 65%, then CPACE is purely additive to that. And it functions more like a mezzanine or subordinate piece of capital. Other lenders say, hey, I only want to see 65% of exposure of recorded mortgage exposure on this asset. So I'll allow up to that, but I'm going to back CPACE out of my debt. So if you have 5% CPACE, I'll lend 60% because my debt plus CPACE will equal 65%. So one of the things I would say is that we've seen a lot of variability around how banks in particular are underwriting and assessing CPACE. Because CPACE is still a fairly new program, we have not made any loans, so agency loans, on properties that already had CPACE in place. So I guess I'm going to punt a little bit because I'm just not as familiar with all of um, uh, the strings, I'll just say, that are attached with that financing and how we would underwrite it or how an agency would underwrite it on a takeout basis.
Got it. Zach?
Yeah, I mean, we've definitely tried to structure deals with CPACE, and candidly, it hasn't really come to fruition. And I don't know if it's for a lack of trying or just a lack of understanding how the product works. But I think sometimes we kind of go into a scenario thinking that the CPACE is going to, provide a little bit more capital than ultimately ends up being the case. And certain things like, sort of the layout of the building or the efficiencies that we thought were there are not necessarily there. The financing comes in to be a bit lower, and it doesn't really pan out the way that we think. But candidly, it's an interesting financing option. I'm curious to learn more and maybe potentially structure a deal. I mean, at the end of the day, from our perspective, there's some hesitation with respect to future sale or how a buyer would look at it, but there's also just the fact that CPACE is call it mezzanine financing, but in reality, it's sort of even primes the senior because it's related to tax payments, but or it's financed through the tax payments. But if you make those payments, then like generally speaking, there's no there's no covenants, and so it's pretty attractive. So we've tried, but we just haven't been successful. So, and it's interesting.
Got it. And Zach, anything to add on my financing options for this expansion project?
Yeah, I mean, to Matt and Nick's point, if you get the market study correct, then feel like you have a good product and a good story, and the maybe there's a senior lender that is willing to sort of carve out a parcel that you can then finance separately from the existing AL memory care. I think there's some interesting options, and maybe it's a sort of a construction lender, a bank that comes in. Maybe there's as the fact pattern mentioned, some CPACE, or maybe we come in and provide some preferred equity or mezzanine financing. And then you hint at the cottage idea, and it's interesting. We're trying to wrap our arms around it. We've sort of bid on some projects, and we're trying to work with developers, including those who have existing assets that are looking to expand those campuses. And I think it's a product we're looking to understand, and I think it's one that could very well complement AL memory care. It doesn't necessarily have to be IL. So
I think one of the things that that this scenario, Ben, brings up, and it's something that quite frankly most of us in the space really haven't or didn't contemplate, and that is, what's the campus look like, what's the expansion capability, and what's the plot plan look like, right? So a piece of expandable property that is on a separate tax parcel is a very different scenario than going into an existing tax parcel with an existing property but expansion capability. And that's driven by loan documents and changes in collateral and all of those things. So one of the things that I would suggest to folks who are developing now and contemplating development and thinking that a phase two might be a memory care or phase two might be ancillary cottages around the perimeter, to the extent that you can separately plat those assets, you're in a better position from a collateral perspective and your construction financing.